Hi, welcome to this video update, which is all about learning from two brothers from New Zealand who could be considered probably the greatest living investors or traders based upon their track record. They are Richard and Christopher Chandler. Now, not many people have heard of them. They keep a very low profile, but their track record is amazing. They started their fund off with $10 million. Within 20 years, they built that up to $5 billion. That's a compound annual growth rate of 35%. Even more impressive, they didn't use any leverage. Now, if you compare their track record against two considered investing greats, Warren Buffett and Ray Dalio, Buffett and Dalio lagged the Chandlers by a considerable margin, both compounding around 20%. Now, in terms of the Chandlers, their philosophy of trading is fantastic. It's very motivational as well. They've got a lot in common, actually, I think, with George Soros. But the way they think about the markets, the way they trade, we can all learn from, in my view. I think their story is pretty motivational as well. I'm going to go through some key points in relation to their trading success. So we'll discuss the points in more detail. We'll just go to a storyboard now and go through them. All right, let's have a look at 6 points in relation to why the Chandler brothers were so successful, or are so successful. Now, just before I forget, you can actually join our mailing list on the link beneath this video, and I'll find some articles and other information on the Chandlers and send them on to you. You'll also get regular emails on the best traders in the world, the best trading techniques, etc. It's free. You can join on the link beneath this video. Right, now let's go through the 6 points. Now, in terms of the Chandlers, very contrary investors. Nearly all the world's top investors are very contrary to the majority and reject, what is commonly accepted investment wisdom. That's what we have to do as traders as well. And the Chandlers are just so successful. And in terms of point number 1, where did they learn their philosophy of trading? Their mother's department store. She ran the biggest upmarket department store in New Zealand. They worked there when they were kids, back from college in their holidays. And they thought their mother was the best businesswoman they'd ever seen. I mean, everyone likes their mother, but their mother extremely successful, okay? And Richard Chandler said about his mother, her philosophy for business success was never buy something unless you know to whom you can sell it. Buy as much as possible a narrow range of hot items. And they said that inspired them to be just so contrary in their investments. I think it's actually quite a good analogy, actually. Because, department store, they just really stocked up on a limited number of items they knew they could sell and they can make a lot of profit out of. Now, how does that translate into contrary investing in the markets? Well, never buy something unless you know to whom you can sell it. Well, if you're going contrary at a market turning point, there's plenty of people who are going to have to get out of the position and give you big profits if you've got your timing right. And just a narrow range of hot items. Just focus on the best trades that are going to give you the best profit potential. There is no point whatsoever in diversifying, which I've said in numerous videos. Top traders like George Soros, Jim Rogers, Warren Buffett all say the same. You only want to focus on a few of your best ideas. I quite like that analogy, actually. Now, moving on to the way they look at the markets, they use variant perception, and they use what they call the Delta Quadrant, which I think is a great name. Variant perception is a term which I think came from hedge fund manager Michael Steinhardt. We have a completely different view of the facts to the majority. You train your mind to see things differently, okay? Now, the Delta Quadrant would be how they analysed their investments. They sought out everything they could find about the investments. They would look at things that other traders or investors would not. And they said they liked this quote here: to seek facts diligently, advice never. And it comes from Philip Carret. Now, to seek facts diligently, you have got to see through all the media hype and what people believe and go for the facts, okay? Never take advice from anyone, obviously. Never take what's said in the media at face value. A lot of what's said in the media just fitted the past price and is hindsight bias and normally just reflects the majority view. Now, in terms of seeking all the facts you can about investment, in Forex trading that doesn't happen, okay? Most traders are obsessed with just the chart. If you want to be a successful investor, technical analysis is useful, but it's not going to make you rich on its own. You need to basically, in my view, look at the sentiment behind the charts, which regular viewers will know we spend a lot of time on, and also look at kind of information that other traders won't, which will give you an edge. So let's say, for example, do intermarket analysis. If you're looking at USD CAD, you should be looking at the price of oil. If you're looking at US dollar, look at the price of US bonds for interest rate clues. Go beyond what most traders will do. Now, in terms of their way of analysing, it was in shares, it's slightly different, but the principles are the same. So get the really big picture. Now, in terms of most fund managers focus on what can go wrong rather than on what can go right and are afraid to make a call, we are not. Gives you clues to why most managed funds don't do very well at all. They're obsessed with things going wrong. They don't want to take contrary views because obviously they're responsible for their decisions to their investors. And let's say you've got a big bull market in, let's say, whatever it could be, and the media is saying it can't turn around anytime soon, it's going on to X level, there's nothing to stop it. Most fund managers won't do the contrary call because they'll look stupid. They're better off to go with the majority, okay? And then if things do go wrong, then it's like, no one could have seen that happen. That goes on a lot in the fund management industry. And we know this. Some regular viewers will know. We look at the COT, Commitment of Traders Report. Big funds are always wrong at important market turning points. Now, in terms of the chandlers, they're investing their own money. So they're only, basically answering to themselves. They've got no investors to answer to. Now, they were saying that, when other investment managers were fearful, they just were optimistic because, when investment gets too overbought or too oversold, it's at some point going to turn around. Obviously, if you've done your analysis correctly. And George Soros once said, the worse the situation looks, the less it takes to turn it around. What you're really looking for is the bearish or bullish news to be fully discounted in the price and then go against the majority. So to give you an example of their first investment, it was in Hong Kong. China was taking over from the UK, and at the time the Hong Kong property market dropped by 75%, okay, in terms of price, because everyone thought, Hong Kong would just become part of China. Well, that's the worst case scenario. And the chandlers said, well, you looked at what China was saying. They were saying, there's no need to take over Hong Kong. It's doing well by itself. We can let it be independent for 50 years at least and maybe never take it over. So the worst case scenario is in the price they bought. The Hong Kong property market soared. Also, when they bought, the clue that the market was turning was dropped by 75%, and then rentals started to come up a little bit and price, and that was the time for them to buy. Now that, it looks easy after the event that happened and the Hong Kong property market bounced back, but all trends that turn around look obvious after the event. And I think, in terms of the Forex markets, you always look for a full discount of good or bad news. I mean, just an example of what we've been doing recently is basically, a while ago we looked at the British pound, the whole market, looking for a hard Brexit, i.e. the UK to leave with no deal. Well, everyone's sold on that eventuality. Things can probably only get better, and the pound bounced really nicely for us. Now, we're not obviously in the same league as the Chandlers, but everyone can do it. Just look for the good or bad news to be priced, then go the other way. You just got to look at the facts and basically, don't get sucked in to the herd. Okay, and the media, like I said earlier, very often just reflects the herd or the majority. Now, in terms of contrary investing, they make this quote: in contrary investments, the risk is time, not price. What do they mean by that? Well, the price, if you've done your analysis correctly, you've got bullish or bearish extreme, it's going to turn around. Your risk, of course, is it might run on a little bit against you in the short term. Okay, so the way they trade is basically to do small size. They've got staying power. They know when they're coming in at the turn, it is going to turn, and when it does, then basically they'll make a lot of money. Okay, but there is a time risk that can run against you a little bit in the short term. All bullish and bearish extremes obviously do turn. Price spikes fade. Everyone you look at on a chart will. Okay, but you've got to have staying power. So you can do small size. Okay, you can also scale in. If you're small, you can sometimes come in, okay, with your first trade. If it moves a little bit against you, second, a little bit against you, a third. This isn't martingale, it's doing it 3 times. The Chandlers did scale in, but that 3 scale in I've taken from hedge fund manager Leo Freeman Soar, who's a hedge fund manager of hedge funds. And he said his most successful traders from the hedge funds that he was having trade for him would very often just scale in 3 times at a turning point. They would have a set risk, okay, of what they were going to ultimately risk on the 3 trades. And if they were wrong on the 3 trades, they'd be away. But by just scaling in at the turning point, when it turns, of course, you are quickly in profit. Okay. Now, in terms of most Forex traders, obviously they won't choose to do that, although I know Forex traders who do and are very successful. Most traders will come in, pick the turning point, and a problem that a lot of traders have is when they've been stopped out, they won't come back in again. Our view is basically, if you are trading a turning point, you can get a risk reward of, let's say, probably 5 to 1 on the best trades. So we very often come in once, twice, 3 times. We get it on the 4th, then we're going to make money if our price objective is hit. So if you're stopped out, it doesn't actually mean that you're a bad trader. So you can see point number 4, being wrong in the idea. I could have said to myself, I'm a bad investor. I got it wrong. Instead, I said we got in a bit early, but the value is still there. If you still believe in the idea, you come back again. And we are all going to be wrong. And we are all going to be made to look stupid sometimes at turning points, because obviously a crowd might be stupid, but it can be very powerful when a bullish extreme or bearish extreme peaks. On hitting hard, by buying big, going narrow and deep, as opposed to diversifying, you maximize your success. That's from the department store, isn't it? And as a Forex trader, you don't want too many trades. Diversification doesn't work. You can be wrong on 2 trades, or you can be wrong on 10. If you do too many, your losers will just basically dilute your winners. Go for the best opportunities. And this isn't just the Chandlers. George Soros has said this, Warren Buffett, Jim Rogers, numerous traders. You do not increase your chances of success or decrease your risk by diversification. I've said that in lots of videos. Point number 6, the benefits of being contrary. Our talent is to understand the long-term potential of a business. In our case, it's going to be a trade, The market gives you the opportunity to arbitrage what the emotional investor will pay for. It does, doesn't it? You can actually basically position yourself, and the emotional investor, the majority, will pay you big profits. I just finished off with lessons from Hetty Green, another trader that no one really knows, which I featured in a video before, the richest woman in America ever, owned 4% of American GDP. And you can look up my video on her. She had a very similar way of trading the markets as the Chandlers. Anyway, I like the story of the Chandlers. Yeah, I have covered probably most of these points before, but it's from a different perspective. It's always good, in my view, to read up on great traders and learn from them. And I think the Chandlers are basically a lot of lessons for success. Right, that is the video for today. Thank you very much for watching me as usual. Take care. Have a good day.